Hi guys, it's Stock Curry, and we're going to go over every single stock pick from the top 10 YouTubers in just a minute. But first, I want to give you guys a quick market update, and I want to explain some of the changes that are happening right now in the market. Things are happening very rapidly and very quickly, and it has caused some confusion. I'm seeing a lot of your comments, and you guys are kind of all over the place. Some of you get it, some of you don't. And so I want to kind of explain what's going on, why things are changing so rapidly. So first of all, you got to understand that the news cycle right now is very, very fast, right? In the modern technology age that we're in, where news can just be sent all over the world in a matter of seconds, obviously news is coming in very, very quickly. And so right now, things are changing on a daily basis. So it's not that I'm being wishy-washy. I'm just updating my perspective as I get new information that's coming in. So keep that in mind. So here's what's happened is right now these markets overall, they kind of look like a bear market. They're acting like a bear market. And so when I'm going through and I'm kind of looking at this and trying to figure out what's going on, I look at the economics, the economy, where we kind of look like we're going over the next 6 months, and I don't see a bear market in the economy. And so what that tells me is when the stock market is acting like it's in a bearish market, but the economy is going to show growth, that generally means that the stock market is about to have a correction. And so I do think that we are at the very beginning of a correction in the stock market. Now, you guys are well aware that the NASDAQ had a correction back in March. However, two things. One, the correction wasn't really a full-on correction. Yes, it did drop 10.5%, and that does count officially as a correction. However, the NASDAQ only dropped down to the 50-day EMA. And normally, when the NASDAQ corrects, it drops all the way down to the 100-day EMA. The other thing is the S&P 500 and the Dow have not yet corrected. And so they're still due for a correction. And so I think what's happening right now is that the S&P 500 and the Dow are correcting, and that in turn is going to bring the NASDAQ down with it. And so I do think that we are at the very beginning of a correction. So there's a couple of things that you guys can do in order to hedge against a correction. One of the things you guys can do is you can go long on some VIX plays, of volatility plays. You can buy things like VXX or UVXY. The other thing you can do is you can buy some inverse ETFs on the market. These are ETFs that go up when the stock market goes down, such as SPXU. And the other thing you can do is you can move your money into gold and silver and even cryptos. Just be a little bit careful about gold, because in a market correction, a lot of large institutions will keep a lot of money in gold as a store of value. And then when they go through a market correction and they start getting margin called, they will pull their money out of gold in order to cover their margin calls. And so what you end up seeing is, even though gold should be going up, it actually will sometimes go down, especially on days where the stock market is down quite a bit, because large institutions are pulling money out in order to cover margin calls. So be a little bit careful on gold, but silver and crypto are both good. So here's what I am doing personally right now is 50% of my portfolio remains in, 50% of my high growth portfolio remains in high growth stocks. And the reason for that is you just can never time the market. At some point, high growth stocks are going to rebound and they're going to start going back up. And when they rebound, they're probably going to far outperform the market. The question is, when is that going to happen? Is it going to happen tomorrow? Is it going to happen 3 months from now, 6 months from now, a year from now? I don't know. Nobody knows. Nobody can time the market. And so I am holding on to my really high conviction, high growth stocks. In fact, I actually bought more in NOX today. So I'm not getting rid of my high conviction, high growth stocks. I'm dollar cost averaging down, and I'm holding long term, waiting for that eventual rebound in these high growth stocks so that I can then go make a lot of money. And so that's one thing, is I'm not selling my high conviction, high growth stocks. However, I did sell some of my medium conviction and low conviction high growth stocks, and here's where I put the money. I put the money into stocks and things that I feel like are going to go up over the next 3 to 6 months, even if high growth stocks remain flat or go down. And those include things like crypto, gold, silver, banking stocks, and energy stocks. Now, there are others you can do as well, such as consumer goods. I personally looked at those today and decided not to do consumer goods because I felt like the gold and the crypto would more than make up for high inflation. So that's what I'm doing, okay? I pulled about 50% of my money out of my high growth portfolio, out of my medium to low conviction high growth stocks, and I put that into stocks that I feel like are going to do well, including mostly banking and gold, cryptos, and energy plays. Now, the other 50% I'm keeping in that high growth portfolio for my high growth stocks, which will at some point rebound, and I'm dollar cost averaging down as those stocks continue to drop. So that's what's going on. It might be confusing as I'm talking about high growth stocks one day and then energy stocks the next day and then consumer goods the next day and gold the next day. And it's really, I'm doing it all, right? This isn't a competing interest. It's a complementary interest, a way of hedging my account. All right. So that's what I am doing in order to prepare for this coming market correction, which I think is probably already started. So let's talk about why the market might be correcting right now. And there's actually a lot of reasons why the market may be going through a correction. And let me go through them. There's actually probably 4 different main points, or no, 5 different main points that I want to go over. First one is jobs. Jobs are kind of weird right now, right? So we need to see job growth in order to have an economic recovery. And if job growth is slowing, that means that the economy most likely will recover at a slower pace than people think it will. And what's weird about jobs right now is that as of the last numbers, now this is a little bit off because we have unemployment numbers from April, but we have job openings from February. So just keep that in mind. These numbers are a little bit, they're not apple to apple comparisons, but it's as close as we can get. So as of April, the unemployment, we had 9.2 million people on unemployment. And then as of February, we had 7.4 million job vacancies. Think about that. 9.2 million people on unemployment, 7.4 million job vacancies. Where is the disconnect? Why is it that 44% of businesses report that they have job openings that they cannot fill? Why is that the case if there's 9.2 million people on unemployment? It doesn't make sense. And depending upon what your political views are, your answer will vary. If you're more of a conservative mindset, you say that the reason is because the unemployment benefits have been artificially boosted, which in turn means that people are actually making more money on unemployment than they would if they went back to work. And so they're just not going back to work. If you're a little more liberal mindset, you might say that the reason is because jobs aren't paying enough, they're not taking care of daycare and a lot of the other things people need, and people just can't keep working 3, 4, 5 jobs in order to pay their bills, and rates need to rise in order for people to be able to afford to go back to work. And, you know, personally, I think the answer is actually a mix of those two. I think that the hourly wages across the board need to rise. And I think we need to get rid of these artificial unemployment benefits that are boosted due to the pandemic and are keeping people out of work. I think it's a combination of the two. I think both of those things need to happen. But, you know, for now, so long as those things don't happen, we're going to stay in this really weird situation where we have tons and tons of job vacancies and tons of people on unemployment, and the people that are on unemployment for one reason or another, whether it be low pay or daycare issues or, you know, just high unemployment or whatever it is, they don't want to go back to work to fill these jobs. And so until that gets resolved somehow, some way, it's just, we're going to be in this weird situation, and it's going to limit how fast the economy can rebound from the pandemic. So the next thing is the supply chain issues that we're having. This is the second issue that's causing a market correction right now. So we know we have supply chain issues. Everybody knows about the semiconductor chip shortage, but there's other things as well. For example, there's a lumber shortage, which is hindering the entire building sector in both commercial, residential real estate. The entire building sector is extremely hindered by a huge lumber shortage right now. And so that's hurting, and then manufacturing is being hurt for a lot of the same reasons. Plastics are really hard to get a hold of right now. The reason is interesting. There was a huge rise in e-commerce shopping, which in turn meant a huge rise in shipping boxes, cardboard, wood. It also meant a huge rise in plastic from poly bags. So poly bags are little plastic bags used to ship soft goods typically. And so there's a shortage on plastics, there's a shortage on paper, a lot of it due to the rise in e-commerce. And then we also have a shortage on chemicals, such as chlorine, due to this huge chlorine chemical plant fire that we had. And so we've got shortages in semiconductors, we got shortages in lumber, we've got shortages in chemicals, shortages in plastic. There are shortages all across the board. Pretty much everything you can think of has got some sort of supply chain issue right now. And so it is hurting everything. It's hurting automobiles, it's hurting solar, it's hurting manufacturing, it's hurting our builders, our industrials, it's hurting everything. Everything across the board is hurting due to the supply chain shortages. And until those get worked out, it's just not going to get fixed. And a lot of people now, they're thinking that our supply chain issues are not going to get fixed until next year, 2022. And so that's going to further delay the recovery from the pandemic. The third thing that is hurting is taxes. The Democrats want to raise taxes, which they need to. We have a long period of extremely high overspending, and the debt is through the roof, and now we need to get a balanced budget. We need to raise taxes. We need to lower spending, and it's going to happen. So what do the Democrats want to go after? They want to go after the rich, right? And where do the rich make most of their money? Well, they make it through capital gains, through the stock market. And so that's what's going up. It's taxes, capital gains taxes are going to be rising. And then on top of that, corporate taxes are rising as well. Now, corporate taxes, of course, are going to hurt corporate profits, which could in turn hurt stock prices a little bit. But the bigger problem is that if capital gains taxes go up, then people with a lot of money are going to be less inclined to invest in the stock market. They're going to be more inclined to invest in other things such as real estate, where they can do a little bit of tax loopholes, if you will, in order to save some money on taxes. And so that's going to hurt stocks. And so that's number 3. Number 4 is inflation. Inflation is a huge problem that is right on the horizon. It's actually already starting. You can see it in gas prices. Inflation is mostly due to the current supply chain issues. As the demand is picked up due to things starting to reopen, but supply remains low because of supply chain issues, you got high demand, low supply, classic economics, prices go up. And so that is causing a lot of the inflation. The other thing is, how high could inflation go? Well, a lot of economists now are saying, yeah, it's not going to be a 3% inflation like the Fed is predicting. We could very well see double-digit inflation. We could see inflation like we haven't seen since the 60s and 70s and early 80s. And so that could be a major problem. And the problem is, when it comes to inflation, that really hurts the value of the dollar, which in turn is really going to hurt stocks. So what ends up happening is people will end up putting money into stores of value that will rise in times of inflation. And the biggest one of those is gold. Secondary is silver. And I think up and coming may very well be cryptos. Cryptos are probably going to be a store of value and a hedge against inflation. That's my thought. And so gold, silver, crypto could probably all rise as we get higher inflation. The other thing is consumer goods, which you talked about. If inflation does go up significantly, the consumer goods stocks, these things should perform fairly well because people will continue to buy those even at higher prices, and the higher prices should mean more profits for these companies. The other thing is energy stocks will rise as well because people still got to get to work, they still got to drive, they're still going to fly, and as gasoline prices and petrol and all this stuff goes up, those companies will continue to make money as well. So energy stocks, consumer goods stocks, and gold, silver, cryptos all are good plays for high inflation. Now, the fifth thing that is causing this market correction that I think has started is rising interest rates. And the reason that I think we're going to see rising interest rates, even though we haven't already, is for the first time in history since the early 80s. So in late 70s, early 80s, we saw really high inflation. And it was around that time, really it started in the late 60s, but the Fed didn't really jump on board until the 80s, that the Fed started to realize that they were going to have a bit of a change in policy. And they were going to have to use interest rates as a way of hedging against inflation, or more specifically, hyperinflation, which is a really bad situation. That's what destroys economies such as, Venezuela, was it Zimbabwe? I can't remember. Anyway, a couple of countries that have just dealt with super high inflation, hyperinflation, and their currency just gets completely destroyed. Obviously, you need to stop that from happening. And so since the early 80s, the Fed has had a policy that when inflation starts going up, they will raise interest rates in order to curb inflation. And it works. It works great. This is the first time, though, since then, that inflation has started to go up, and the Fed is like, nope, we're just going to, sit back and allow inflation to rise, and we're not going to raise interest rates for, another year and a half. And it's crazy. It's insane. And so a lot of people are thinking, yeah, right, you're a bunch of liars. You're going to raise interest rates. There's no way you're going to allow us to have double-digit inflation. And so because of that, the fears and concerns about rising interest rates are causing people to start selling off stocks, which in turn is helping fuel this market correction that I think has started. So let's talk about, on the interest rates, two things. One, it will hurt high growth stocks the most. All right. That's why I've been very comfortable pulling money out of a lot of my high growth stocks and putting it into things that I think are going to do better during high inflation, high interest rates. But the second thing is it's actually going to help banking stocks. And so if we do get those higher interest rates that a lot of people think we will, then banking stocks should go up, because as interest rates go up, they're able to charge more for loans, which means they're also able to become more profitable. And so that's all that I've got for you guys as far as market updates. You've got a lot of different options on how to hedge your portfolio and take advantage of higher inflation as well as higher interest rates, as well as make money even if the market's going down. I gave you guys a lot of different options, a lot of different ways of doing that. And so with all of that said, let's get into today's stock picks. Now, for those of you guys who are new to this channel, my name is Stock Curry. I used to work as an analyst for some large investment banks, and now I analyze stock picks from the top 10 YouTubers. I spend hours every day watching YouTube videos from the top 10 YouTubers. I then consolidate all of their stock picks into a single video. I give you guys both the cliff notes from the top 10 YouTubers as well as my analysis on their stock picks. If any of the stocks I talk about today piques your interest, make sure you listen to who I say talked about that stock and then go watch their video to see what they said. Now, all I ask for putting all of this together for you guys is that you hit that like button, subscribe, click the bell icon, and then click all so that you can get notified when I release my next video. In fact, I'll give you 5 seconds to do that right now. Alright, before we get into today's stock picks, I just want to remind everyone that I am not a financial advisor and none of the YouTubers I follow are financial advisors either. Today's video is strictly for entertainment purposes only. For those of you who are wondering, you are currently looking at the Webull desktop app. Webull is the app that I use for my trading, and it's also the app that I use in all of my videos. If you'd like to get 2 free stocks worth up to $1,850, you can sign up for Webull using my link in the description below. When you sign up using my link in the description below and deposit just $100, Webull is going to send you 2 free stocks worth up to $1,850. All right, let's get into today's stock picks. First up is Ethereum, but really, I'm just using this to talk about cryptos in general. Now, StockMo did let us know about a new Ethereum ETF that VanEck is launching. What's unique about VanEck's ETF is that they will be holding actual Ethereum. As VanEck buys ETH for their ETF, that is going to push the price of ETH higher. How high? Well, one analyst came out and said that with the move to proof of stake with Ethereum 2.0, that the price could rise to $100,000 by the end of 2025. If that turns out to be true, then you could put $100,000 into ETH right now and end up with over $2 million in less than 5 years. Now, while that is possible, I would be careful about these huge price predictions. Yes, it is true that Ethereum has a lot of positive catalysts going for it that is going to push the price up. But I've also noticed that every time a speculative asset runs up massively, people start throwing out insane price targets. And that is one of the signs that we are near the top and the bubble is about to burst. In November 2017, after Bitcoin moved up very quickly from $900 to $11,000, some people were saying that Bitcoin was going to hit $40,000 by the end of 2018, while others were saying Bitcoin would hit $50,000 by the end of 2018. And one analyst even said Bitcoin would hit $100,000 by the end of 2018. Instead, 1 month later, in December of 2017, Bitcoin topped out at $20,000 and then spent all of 2018 crashing back down to $3,000. There is a lot of money to be made during a speculative bubble like we're seeing right now in crypto. But be aware that we are near the top. And at some point, crypto is going to crash, with some coins dropping over 80% from their highs. I'm investing in crypto right now. I'm making really good money, but I'm also very cautious and looking for signals that the bubble is bursting. Unfortunately, we are starting to see some of those signals, but we are in the very beginning stages. Now, if you hold through the upcoming crypto crash, then 5 years from now, there is a very good chance that you will still be up on your investments and very profitable. If you have more of a short-term mindset though, and you are looking to trade crypto, then I recommend keeping your eye on your crypto so that you can sell before crypto crashes too much. Remember that drops of 80% or more are normal when trading cryptocurrencies. Next up is AMD. This is Advanced Micro Devices, better known as AMD. The traveling trader really likes AMD. It's down right now due to the semiconductor chip shortage. In fact, AMD is really cheap right now, sitting at the 300-day EMA. Once the semiconductor chip shortage is resolved, AMD should skyrocket. The traveling trader likes AMD as a long-term hold. I am also invested in AMD in my long-term portfolio. Next up is CLF. This is Cleveland Cliffs. Chris Zane likes CLF for some exposure in industrials. This is a recovery play for him. CLF had a loss last year due to the pandemic, but it did report profitable quarters in these last 2 quarters, and the stock is rising as a result. My concern with CLF is that the stock is already trading at more than double what it was trading at in 2018 when they reported excellent earnings of $3.42 a share. Based upon the average of the last 2 quarters, CLF would have an earnings per share this year of 44 cents. Which given the current price would give it a PE ratio of 48.6. That is quite high, so I actually think CLF is overpriced right now. Next up is COIN. This is Coinbase. This is a platform that is used to trade cryptocurrencies. StockMo let us know that COIN is reporting earnings on Thursday after the close. Most analysts and option traders are expecting COIN to beat earnings, especially given the huge increase in interest in cryptocurrency trading over the past few months. StockMo bought more COIN this week. Also, the average analyst one-year price target is $433.50, which represents a 43% upside from Tuesday's closing price. Just expect a lot of volatility over the next few months, though, as COIN works to find a proper trading value. Next up is DIA, which is a Dow ETF. The traveling trader bought a put option on DIA as a hedge against a fall in the Dow. The traveling trader said he would not be surprised if we see a correction since the Dow and the S&P have not yet corrected. Only the Nasdaq has corrected. The traveling trader said you could also buy gold or silver as a hedge against the drop in the Dow, and that is exactly what I did today. Next up is DIS, which is Disney. The traveling trader let us know that DIS is reporting earnings on Friday, May 14th. Even though DIS has dropped quite a bit and is currently trading near the 100-day EMA, the traveling trader recommends waiting until after earnings before establishing a position. Next up is DKNG. This is DraftKings. They're an online sports betting company. StockMo said he bought more DKNG today when it dropped down to $42. DKNG is extremely oversold right now, actually trading below the 300-day EMA. The RSI is also showing oversold at 22.79. Despite that, the MACD and the chart remain quite bearish. Now there is support at $35. So it's possible that DKNG could drop all the way down to $35 before bottoming out. It is also possible that DKNG responds to the oversold price right now and rebounds from here. Because we're not sure what DKNG is going to do, StockMo only bought a little bit of DKNG today, and he's holding more cash on the sidelines in case DKNG drops further. In other words, StockMo's dollar cost averaging down on one of his high conviction growth stocks. Next up is FSLY. This is FSLY. Paul Nguma likes FSLY as a short-term trade. The reason is because FSLY fell a lot after earnings, and now this is a recovery play. The chart pattern has been bullish over the past few days, so Paul Nguma thinks FSLY is about to rebound. Paul Nguma sees FSLY closing the gap back up to $57. If that happens, you could potentially make about a 20% gain on this play. Next up is MS, Morgan Stanley. This is an investment bank. Chris Sain said value stocks would outperform growth stocks this year, and he recommended buying MS. MS has a PE ratio of 11.15. Keep in mind that fair PE ratio is 15. So MS would have to rise another 35% to get back to a fair trading value. Next up is NIO. This is NIO. They're a Chinese EV manufacturer. Keenan Grace let us know that one of the largest owners of NIO, Bailey Gifford, significantly cut their position in NIO. They sold over 15 million shares, which represented just under 15% of their total position. Now personally, I would not be too concerned. While NIO did open very low today, close to the 300-day EMA, it recovered back to the $35 support level by close. And as we can see on tip ranks, the average analyst price target is $62.50, which represents a 79% upside from Tuesday's closing price. This is one of the reasons that I'm quite bullish on NIO and why I felt comfortable buying an NIO Leap call option. Chris Sain lowered his price target to $65 and said NIO is currently in a buy zone. Next up is PLTR. This is Palantir. They're a data analytics company. PLTR reported earnings today. Earnings were in line with expectations, but the stock rose today because the sales forecast was exceptional. PLTR expects sales to grow by 43% year over year in the second quarter. They also said they would accept customer payments in Bitcoin, and the company is considering whether or not to invest their cash into Bitcoin also. Now, Tom Nash reviewed PLTR's earnings call today. He highlighted the fact that PLTR said they want to become the largest software company in the world. PLTR also addressed the constant insider selling and explained that the compensation plan includes stock options. When someone exercises stock options, they have to pay taxes, because the value of those stock options are considered income. So insiders are selling a small portion of the shares that they receive through their exercise of the options in order to pay taxes. And that's all. Nothing to be concerned about there. PLTR also said that they were focused on growth right now, not profits. That is actually quite concerning in the short term because it means PLTR will need to raise cash in order to support its business if it's not profitable. And that could come in the form of a share offering, which would put downward pressure on the stock. Now, in the long run, growth is good. PLTR is working to expand to smaller sized businesses, which will increase its depth and provide more security to the revenue stream, as well as help the company grow further and eventually achieve their goal of becoming the world's largest software company. By the way, the largest software company in the world today is Microsoft with a market cap of $1.85 trillion. PLTR currently has a market cap of $33 billion. So if PLTR does achieve their goal within, say, 30 years, then PLTR would have to become a $2 trillion company by market cap, assuming that Microsoft does not grow much over the next 30 years. That would put the share price at around $1,200 or 60 times higher than where it is right now. That averages out to a 14.6% annual growth rate in the share price, which is actually quite reasonable. The traveling trader also said today that he is long-term bullish on PLTR, and he said any price under $20 is a great price to buy in at. Chris Sane called today's rise in price a pump fake and said he sees PLTR getting back down to $17 or $18. I personally think that in the short term, PLTR should be trading between $20 and $24. I do not expect much price movement above $24 for at least 3 more months. So I think you have some time to dollar cost average in for a long-term hold on PLTR. Finally, we have TTD. This is the trade desk, and they're a technology company focused on analyzing companies' advertising. The traveling trader said this is a little bit riskier than some of the other stocks he likes right now because it has fallen so much. The traveling trader likes TTD as a recovery play due to the overreaction from their earnings. Despite the huge drop in price, most analysts upgraded the stock and increased their price targets post-earnings. TTD is also doing a 10-for-1 stock split on June 17th, which usually causes a bull run going into the stock split. Taking a look at tip ranks, the average analyst price target is just below $800, which represents a 54% upside potential from Tuesday's closing price. Alright, I hope you enjoyed this video and got a lot out of it. Comment down below how you're going to be preparing for the possibility of an upcoming market correction. And if you guys want to get some free stocks to help you out, you can sign up for Webull using my link in the description below. When you sign up using my link and deposit just $100, Webull's going to send you 2 free stocks worth up to $1,850. They're also going to give me 1 free stock, so it helps you out and it also helps the channel out. Finally, remember to hit that like button, subscribe, and click the bell icon if you haven't already. I hope you have a lot of success trading, and I will see you tomorrow.